Hey guys, what's up? It's Dem here at Dem Talks. Hope you're doing well. So today I'm going to go through a rule 1 of value investors core principle, and that is kind of understanding a profit and loss and a balance sheet. Now, they're two of the three most important financial statements that you'll come across, and I know people just normally talk about basically what it is, but today I'm actually going to show you what it is and actually go through an example of how it's put together. So it should hopefully give you a bit more of a understanding, and so that when you look at them next time, you at least know how some of the figures in there are being calculated. So without further ado, let's take a look. Okay, so let's start off with a P&L. What is a P&L? Also known as an income statement. Basically, all that does is it's a kind of a video over a company's performance over time. Normally that's from the start of the year to the end of the year over a 12-month period, but it can be over any time period, such as 1 month, 1 week, whatever. Now, what a P&L is designed to do is basically show how profitable a company is, and the main structure of it is that you get your income and you less your expenses, and whatever is left after that is profit. So it's kind of used by investors just to gauge how profitable a company is over time, and it's probably one of the most likely to be kind of manipulated, because as rule 1 investors and traditional investors don't really spend that much time on the profit and loss, in that the general figures that we get out of it is probably like sales revenue, net profit, etc. So it's probably one of the most likely to be manipulated. So you just got to be a bit careful with that. Now, I suppose the way that the main structure of the P&L is designed is that first you get your sales, then you get your cost of sales, so that's everything that's directly attributable to you being able to sell that product. And then after that, you get your expenses, which is like your utilities, rent, etc., which are kind of more broader expenses and not directly relatable. And then lastly, you've got your net profit, and your net profit just basically shows how much profit you've made from providing that service or goods. So a balance sheet, on the other hand, shows a picture of a company's financial structure for a set date, and it basically, the way that it's configured is that you have your assets should equal your liabilities and equity, which is equity is kind of the things that you put into the company, any shares, etc., which is used to fund the company from a start-off position, and it basically just helps you to understand what a company's worth. So this kind of area takes quite a bit of interest when you're doing value investing, in just looking at how the capital structure of a company is built up, how much debt they've got, etc. This can be found in this area. So it's definitely a key area for investors like us to take a look. And then I suppose them two big statements kind of just come together to just give you a kind of a flavor of how a company's doing overall. So now, if we actually look at the third financial statement, which I'm not going to cover today, is a cash flow statement. And that is, people always say cash is king, and the reason why cash is king is because in a P&L, just because of accounting principles, etc., the profit that you report might not be actually a true profit, because you take into account things such as depreciation and all of the kind of costs which then can kind of distort your true profit. Whereas cash is basically your physical cash, and that's money coming in and money coming out over time. So it's kind of an outflow, and it just gives you an idea of like how well you're managing your cash, because at the end of the day, a reason why most companies fail is not because of profitability, but because of cash flow issues, and that they can't either pay their suppliers on time or pay their staff on time, and it just creates a lot of liquidity issues. So I'll cover that in a separate video of basically the difference between a P&L and a cash flow, and actually an example to show you. But today we're just going to go through an example of a P&L and a balance sheet. So today I'm going to try and basically teach you a bit about accounting, as well as just going straight through an example. So today I'm going to set up my own company called Derm Supercars. Now, Derm Supercars is basically a car dealership, and it's something that I've always wanted to do, and I thought today I'm gonna go for it. So I'm going to take £10,000 that I've saved up for a long time, and I'm going to invest it into this business. Now, in return, I'm going to get £10,000 in shares worth, and that is kind of my equity within the company. Now, I've got some other kind of transactions that I do over the period of just 1 month, and I'm going to talk about them. But the way that this is going to be structured is that I'm going to first talk about kind of how this sits from a double entry point of view. So in accounting, every transaction must have like a basically double entry. So if it goes into one area, there's a debit and a credit. So they always have to balance back to zero. So I'm going to show you exactly which accounts these different transactions hit, and then we're going to put that into a trial balance, which is basically just a balance of debits and credits, and that the total of them should equal zero, and then we're going to put that into a profit and loss just to show how that then comes through into the financial statements and what you'll see. So it's a bit more of an in-depth view, but hopefully by you understanding how all these transactions interact, it'll give you a bit more understanding. If I take my £10,000 that I've invested into the business in cash, and the £10,000 that I've get in return for equity, basically I debit cash 10,000 and I credit my owner's equity account by 10,000. Now I then take out another loan because I need it for a buffer and kind of liquidity, and I'm going to take it out for £5,000. Now obviously the bank's going to give me £5,000 in cash, so again I'll debit £5,000 in cash, but this time I've got a loan repayable or a liability that I need to pay back, and that's 5,000, so I credit 5,000. Next one is I actually purchased £3,000 to buy some stock of cars. So I'm going to buy 3 cars, and they're worth altogether £3,000, and therefore I paid in cash for it, so I'm going to credit my cash account by 3,000, and then my inventory now is going to increase by 3,000. Next, I'm going to spend £50 on basically some car valeting supplies. I need to make sure that my cars are looking spick and span, so when people take a look at them, they're thinking, yeah, this is slick, and this is a car that I need in my life. So I spent £50 on it, but this time I haven't paid it in cash. I've actually paid it payment on account. I've got someone who's actually willing to trust me that I'll pay them in the following month. So this time I've actually debited my supplies because I've got inventory of £50 in supplies, and I've actually credited my accounts payable. So this is basically that I need to pay someone in a month's time of £50. Next, someone's seen my spick and span cars, and they're actually loving what I've done, and someone's actually offered to pay me £5,000 for one of the cars, and I've sold it, and it only cost me £1,000. Now the way that this is going to work is basically I'm going to debit £5,000 of cash into my account, and I'm going to credit my revenue because I've sold £5,000, and then I'm also going to have to debit and credit my inventory because now the £1,000 that car was worth has come out of my inventory, so that's credited out my inventory, and then that's added to my cost of sales, which is basically the cost associated with actually selling that product. So it's £1,000 in this case. Next and finally, we've got a telephone bill. Now I've been calling a few people trying to hustle and trying to tell them about these brilliant cars that I've got to show them, and my phone bill's come in and it's actually £30 for the month. So again, I'm going to pay by cash. So I'm going to credit £30 out of my cash, and here I'm going to have an account for telephone bills, which I'm going to debit £30. So altogether, you'll see that the totals come to this, and basically if you add them all up, they should come back to zero because of double entry bookkeeping. So one debit must basically have a credit, and therefore all the debits and credits should come back to zero when they're added together, as you can see. Now the next step that we go through is basically just putting it into this thing called the trial balance. So trial balance is basically, as I've just said, like the debits and the credits must equal the same amount and therefore equal to zero. So as you can see, on the debits, we basically put all of our dividends, expenses and assets here, and a way to remember it is dealer. So dividends, expenses, assets, and on the liabilities or the credit side, we put liabilities, equity, and revenue. Now, if we split them transactions out into the following areas, we see that again it comes to 20,050, and both sides cancel each other out to zero. So it's a good sign. Now, if we're going to now put that into a P&L and a balance sheet, we basically move the £5,000 in sales down to here. So our revenue is £5,000 from selling the car. Next, our cost of sales, which is basically the way that you calculate this is that you do opening stock, which was zero because we started the company with no stock, plus our purchases. We made £3,000 worth of purchases of inventory to buy the cars, less any closing stock. So at the end of that period, we actually sold one of the cars. So our closing stock is now £2,000, and so therefore our total cost of sales is £1,000. So that £1,000 goes into here, and that means that our gross profit before any expenses is £4,000. The next point in the line comes our general expenses. Now our general expenses are just basically telephone bills, utility bills, rent, etc. And in this case, we spent £30. So the £30 gets knocked off here, and our net profit for the period is 3,970. Now, moving to a balance sheet, which kind of shows us our financial structure of a company, we basically know that in our cash, we've got £16,970 left, and that's just after all of the expenses and money coming in and money coming out. Now, supplies, so we actually have £50 worth of car valeting supplies still left, so that's kind of inventory or just general stock. So that's £50 there. And then we've also got our car inventory, which we still got left, and that's worth £2,000. So our total assets is basically 19,020, but to balance off them assets, we also have some liabilities. So now, remember the supplier that we bought the car valeting products off of trusted us to pay them back in 30 days, and we have that liability still there, so we've got £50. Next, we've got the loan repayable back to the bank, which is £5,000, so that's still a liability that we owe. And then as for equity, we've actually got, which basically shows how our company is structured. We've got the £10,000 that I invested, so we've got £10,000 worth of shares that I've got, and then also we move the net profit that we made in that period, so the 3,970 from the P&L into this account called retained earnings, which is basically moving the profit over. So now our total equity plus our liabilities is 19,020, and our total assets is 19,020, and perfect. Assets equals liabilities and equities, and that is the balance sheet. So hope you enjoyed that, and let's go back. So guys, I hope you enjoyed that. I hope it provided some value and a bit more insight and understanding. If you did like that, I would appreciate any likes or subscribes, and comment below to see just if it was any helpful for you, or if there's anything further that you want clarifying. But as I said, in the next video, I'm going to look to do basically a difference between a P&L and a cash flow statement, just so that you know kind of how important cash is and how cash is king. And also leave a comment below if you want me to do a video on ratios and kind of the key ratios, such as like gross profit margin, net profit margin, and what they mean, so that it kind of gives you a flavor or understanding as you start analyzing either P&Ls or other companies in future, just to really understand profitability. So thanks again, and enjoy your day. Catch you later.